Good afternoon, everybody. This is Jeff Scott. It's Sunday morning. Actually, good morning. It's at 10:13 a.m. This is August 2nd, 2015, and this is my weekend review. Welcome back to people who've been here before, and welcome to any new users. My email address for all contact is hgsidoc@gmail.com. Actually, I got about 12 emails, but that's probably the best one to use. Again, title today, still range bound. Let's take a look, although it's kind of an interesting market. Disclaimer, this is for education purposes only. Any recommendations are in the spirit of education and not investment advice. I'm a doctor, not a broker. I am not affiliated financially with any software vendor or trading company. Any tools that I demonstrate are those that I use in my daily trading, and I have paid for all those that I demonstrate. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. I wanted to stress that third bullet point. I mention a lot of products. Nobody pays me if you buy their products, although I appreciate you buying the products that I use because that keeps them around. And I get nothing for promoting positively or negatively anybody's product. I always start with my be your own guru, key influences on my style. I really think that it's our responsibility, each of us, to take responsibility for our trades and for getting the education and the appropriate tools to make the trades. I was fortunate enough to meet this guy here in the upper left-hand corner, Ian Woodward, back in the early 90s when he was doing some speaking on behalf of Telescan, and he really introduced me to O'Neill and CanSlim. He took CanSlim and made it his own story with additional neat indicators and concepts. Ron Brown is his partner. The two of them, with George Roberts of hgsi software, created a tool that allowed me to do top-down investing in CanSlim, although it's useful for almost any type of investing. Morales and Katcher have really taken O'Neill and take it to the next level with Bible gap ups, pocket pivots, short selling. This is my buddy George Lee. Alexander Elder, author and trader, got some good concepts that I learned. Tom Dorsey, I'm not a point and figure guy, but I like how he uses comparative relative strength. Van Tharp, position size and money management. Anna Cooling, a very good approach to volume spread analysis. What does volume mean in relationship to price? And that's a book that you can get off of Amazon. It used to be about $5. And then probably the person that's my biggest influence today is John Person. Here's a couple of his books here, and I'll talk more about John. John's been trading for a long time. I think many of you realize that I've become very good friends with John. I actually have a trading desk in his office, and we talk trades several days a week. And I'm very fond not only of him, but of his style of trading and the tools that he uses. And I actually, at my last meeting, came up with a special price on his tools for those that attended, and I have the ability to extend that deal through Tuesday. We'll talk about that more in a couple seconds. I have a lot of toys on my desktop, and I only use a couple of them. I need TradeStation or Thinkorswim. Frankly, I prefer TradeStation from an analytic perspective. I think the interface on Thinkorswim for trading is a little bit simpler. Genesis is an all-purpose charting program. I think it provides me value, but would I recommend it? I think each of us have to make our own decisions. I'd rather spend the $2,000 on John's stuff than buy another charting package that sort of potentially duplicates what you already have. From an analytical perspective, hgsi is my post-market and delayed intraday time market analysis tool. EdgeRater is, George and I were emailing the other day, and he actually called it the first authorized add-on to hgsi. And in many ways it is. It's a freestanding program, EdgeRater. It's built upon some of the concepts of hgsi, but more importantly, it's the only program that actually integrates with the hgsi data, which streamlines my analysis. I'm a big fan of seasonality. I'm not going to get into the fight here except to say I own all the programs that you can think of, and there's obviously some in the market, there's some competition. And then there's a number of websites I like. Market thoughts. We continue in a trading range. Now, at this point, I've actually put a question mark instead of calling it a topping process. And I'm beginning to wonder if this isn't the correction, is just a sideways correction. I mean, do I still think we're going down? Yes, I still think we're going down. But what I think is meaningless. I have to see what the market does. And we're just going sideways, although you'll see sideways looks different depending on what instrument. Spiders, Qs, and IWM reversed off their moving averages. We'll see that the Dow is sort of stuck underneath the 200 where it's turned into resistance instead of support. The Canaries resisted their carnage and they're just off their highs. Interesting, this is despite the fact that Facebook sort of had a negative response to earnings, and LinkedIn and BIDU, although BIDU is not a canary, got clobbered. Compared to last week, there's a whole lot more leading industries, especially interest sensitive, such as REITs, utilities, MLPs, and bond funds. Defensive stocks, utilities, bonds, and tobacco look good, and healthcare remains in focus. This time I found some great setups on the long side. Energy is still weak as oil searches for a bottom, and Fed's out of the picture for another month, as even September is now a question mark. And boy, if you missed your earnings or your revenue, you're punished hard. Now, I added a new feature this week, which is going to be my chart of the week, and I'm going to talk about why I like the chart and how I'm going to manage it. Again, if it behaves, then we'll talk about that. So stick around to the end and we'll go through that. I know I had a lot of comments of people like me talking about how I'm going to pick what stock to trade and what I'm going to do with it. This is what Friday looked like at end of day. So what stands out to me, energy is hammered. I don't care if you are XLE, XOP, OIH, you were red. Interestingly, banks were down. Now, probably, and insurers and broker dealers and credit cards, perhaps that's related to interest rates eased a little bit after the Fed spoke. What was working? Well, if you go through, I guess home builders to some extent, the home builders themselves are over here. REITs, gold miners popped up a little bit on Friday. Utilities were strong. Healthcare remains fairly strong. Biotech had a good end of the week. But clearly this is not an all green board. If you look at, this is just a 3x3 or 6 charts, or 3x2 rather, that I do on E-minis, NQs, YMs, TFs, the VIX, and the dollar. Now, on all my charts, I have at least 3 moving averages. Typically green is the 17, yellow is the 50, it could be blue on a white chart, and red is the 200. So if you look at the E-minis, they bounced off the 200 back here early in, I guess that must have been in last month. This month, again, they pulled back, or in July, they pulled back to the 200 and bounced. And right now, the E-minis are bouncing around above the 50, and the 17 is about to go through the 50, which to me is a good sign. If I look at the NQs, a similar story. They didn't quite pull back to the 200. They pulled back to the 50 and they bounced, and they're above the 17. The Russell pulled back the hardest and actually closed, this is a daily chart, did daily close on the 200 but did trade down intraday, and it saw resistance at the 17 on Friday. This here is the VIX. The VIX failed at the 200. It is now down below the 17. Flip that around upside down. It looks a lot like the TFs. The dollar is holding on the 50. And then the YMs, which are the Dow futures, are struggling to get back above their 200. Do you notice that on every index and everything I saw, I talked about a price relationship to moving averages? I think that moving averages tell a major story of what goes on in the market, and that's why I use them. I mentioned about interest rates. Here's a weekly on the rates, and you could see we closed down again this week at the bottom of the week, 2.205 it looks like. Falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. Rising rates are good for banks, especially the regional insurers and probably credit card companies. I pointed this out a couple of times, and you could see the indecision, the buying power in black, the selling pressure in red. This is from Lowry Research. It's an expensive service I have, but it's really outstanding in how they give me interpretation of the market as well as some leading indicators. And I would say they're still on a sell sign if you read their reports, and that's because the selling pressure is exceeding the buying power. But we're sort of in a land of where it can go either way. Now, one of the things that is pretty clear to me is that this market is not, it's not a single market. Small stocks have been weak. This is the NASDAQ in white overall, the NASDAQ 100 in white on the right-hand side. The green represents the AD line on the overall NASDAQ. And you could see that the AD line on the NASDAQ is selling off despite prices going higher. If you look at the NASDAQ 100, you've got total correlation. So what does that tell me? It tells me the big stocks are performing fine. It's the small stocks where the weaknesses are. Talk about weakness. This is the I think these are the spiders. Should be the spiders. And you can see the spiders are not at their highs, but they're much closer to their highs than their lows, and they're bounced off the last week. And you could see the number of stocks participating. These are above the 200-day moving average and above the 400-day moving average is we bounced off the bottom. Now, I guess if I wanted to be wishful thinking, I could say that we have a lower low on the stocks that are below the 200 and below the 40, and perhaps that tells me the market's going higher. I don't know if I can make that correlation. I typically use this as a signal of when the market is oversold and going to bounce, and there's a pretty good correlation between when you get down very low from when the market bounces low, 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 low. When you get lows and reversals on these on the green, you usually get a market bounce. Canaries, I mentioned they're holding near their highs. I wish all my stocks looked like this because I guess it's kind of a pullback to support on the 8-day exponential with the doji. These are the canaries, and despite some carnage in the market on some of the stocks that missed earnings, these are holding up relatively well, and again, they're right off their highs. As I always say, stock patterns are cyclical. I want to be going long aggressively when a stock is breaking out of a base and the markets are in the base, are breaking out of a base as well. I want to be shorting and being careful when I think the market or a stock is in this period of time where it's beginning to get marked down with fear and selling. And I look at the market every day and try to understand. And this has been very tough for everybody as we're sort of living in just this little piece here. And every time I think it's going down, it goes up and so on and so forth. And that basically is a trading range. And how I play this market depends on where I think I am. And this goes for how I trade stocks and how I trade overall based upon market cycles. This will be an interesting news week. I put yellow there as sort of a danger yield warning sign because we have the monthly unemployment, or as John refers to it, the unenjoyment report on August 7th. This is a kind of thing that moves the market. For those people that are thinking rates are falling, they're probably thinking that the Fed's not going to raise. And therefore, they are going to be watching unemployment and the payrolls, because if it's a big beat, then that would be more pressure to raise, and that may cause some of those interest-sensitive stocks to be punished. I'm not going to go through these, obviously. I see Horizon, one of my favorites, is Friday, so I've got to be aware of that. But you need to know which one of your stocks are going to be reporting earnings and when. And there's many, many resources to find them, including a free indicator and TradeStation. But here's Levitt Brothers. This is a free, well, it's not all a free service, but what I have here comes from their free service. This is my comment, my quote. It's a judgment call. Sometimes a bad judgment to hold stocks over earnings. It's bad judgment to not know when your stock's earnings date is scheduled and be surprised. So we're going to go through the market, top down, bottoms up, and I'm going to conclude with my chart of the week analysis. For the PUG folks, I've already updated the symbol list in the Dropbox, so that's got the new list that we use that you can use for scanning. I'm going to do 2 movies this weekend. Hopefully I'll have time later Sunday. How to add a Similarista TradeStation and how to make custom scans. All full members, including those that purchased after the Thursday webinar, will get an email by me before I go to sleep tonight. That could be 2 in the morning, so you'll see in your mailbox about Dropbox access. If you have not gotten an email from me and you are a full members are those that own HGSI and own John's Indicators, please email me so I can get you access. I want to do a closed pug meeting. I don't know why I called it plug. I'm thinking back to that crazy stock that I owned last year for a while. I will hold a pug meeting online this week just to review setting up the indicators once again. This will not be an open meeting. This will only be for pug members. And if you're not a full pug, you're an associate pug. And those would be people that have been to my live meetings, have bought computers or indicators from me. It may or may not be worth your while because we're going to spend more time on just the indicator setup. And then I do have a special package pricing, which they'll honor through Tuesday. Here's the deal. If you want to purchase this, it's purchased from John, not from me. He sells his lifetime indicators normally for $3,500. I have a package of indicators for TradeStation that I rarely will sell for $500. Plus you get full membership in the pug, which includes 2 semi-private web sessions with John where he's going to teach pug members how he uses his indicators. I've put all this together, and Mary and John will accept a deal through Tuesday for $2,800. There's the offer link. It really is a great deal. I paid full price for mine. My indicators I'm just giving for free as part of the package. And I think it's a great price. And getting John to come into the pug meetings is going to be priceless because he is, not only is he a brilliant guy, but he is a hoot. Upcoming meetings, I don't know what it is about October, but I will be speaking with George Lee and others October 16th through the 18th at the Greg Mills Orange County meeting. October 24th through 26th, the PV meeting is a go with Ron and Ian. Highly recommended that especially if you've never been there, you've got to go. It's just, Ian is just such a wealth of information, and Ron is just such a great technician and so great at using the tools and teaching us the tools. Unfortunately, I have a wedding this October, that weekend, so I won't be there. The following weekend, John Person's actually holding a seminar in Palm Beach Gardens. I will be speaking at that one. In fact, this is basically October 31st through the 2nd. I would expect it to be 90% John, 10% me. If there's enough of the folks who follow me that are coming, I probably would be willing on the Friday afternoon to get together 8, 10, 15 people, whatever it is, in my condo in the theater, and maybe do a couple of my favorite HGSI presentations as sort of an intro to the meeting. So if we have enough interest, and I'll say a minimum of 5, I will do an extra day at no cost on Friday afternoon. We'll come back to my chart of the week later. Let's go and take a look at the market. So let's start with my Excel spreadsheet this time and look at the market that we had. It was a surprise to me. I hated last week. I opened down most days, closed up. I guess that's a bullish market, but boy, was it painful. So the first thing you see is, despite the pain in the market, there's a lot more black than red. That means the market was up. Actually, I don't want to look at that one. I want to look at this one. If you look at the S&P 500, it was up a little bit over 1%. Now, just to give you an idea of how tough this market was, and my spelling really sucks this week, here's how tough. IBD 50 was actually up only 0.39%. The GIF All-Stars that I make was down 1.16%. The HGS 100 was up 1.48. The stocks that I picked last weekend, I did not great percentage positive, only 56 positive, but I was outperformed the S&P. I was up 1.48. What's interesting is our box is back. I take a large list of stocks, and about 80 of them, in this case 69, were box 1, 2, or 7, and they were up over 2%. And here's my favorite scan, or one of my favorite scans. Stocks in uptrend with a pullback with a kahuna near the 50 or free parking. They were up twice the S&P. And no shocker, my stock of the day, our chart of the day, is coming from this group. So, stronger market than I would have felt from my daily feel. Buy list did okay. Hard to say that, whoops, did I kill this? That was filtered buy list. Hard to say that that growth stocks were in vogue. It was just a tough week, period. There was no new Hindi signals. We had 2 in June. We had 1 July 23rd. What's interesting, and I guess it shows not necessarily strength in the market, but less weakness, is our new lows got up to 14.5% on Monday. And by Friday, the new lows were down to 2, and we're now above 3% on the new highs. Bucketology, we're at 50-50. We've got very few stocks above or below. But it's kind of showing you that this is a market of winners and losers. If you go back about a month and an extra week, this is what a bottom looks like. Actually, not a bottom. You go back, 1 week, this is what we look like, and we predicted that this would give us some element of a turnaround, and we've had some, but tepid, I would say. Markets, the last couple of days, there's some kahunas to the upside on Tuesday and Wednesday, but they really, unfortunately, don't seem to have amounted to anything, and we continue in this chop range. And let's just look at seasonality for a second. What I do is I run a couple of scans in EdgeRater. The first thing I'm looking for on the left-hand side are stocks that have a, I'm going to concentrate just on this group here. I'm looking at 1 month return from today, and where do I find stocks that have had a lot of up years and what return. Now notice that you've got Newmont, Royal Gold, and AEM all up 16 or 17 out of 20 years with returns over the next month of up to 11%. Perhaps this is a time where gold turns strong. It's obviously been weak. But then I take it over on this side, and what I did over here is I've tried to just ferret out the background noise, and you had to have at least 8 up years and no more than 3 down years, and then I've ranked it by percent. So Dexcom is up 9 out of 10 years, 11%. Eldorado Gold, 11 out of 12, 11%. Still a lot of gold and mining stocks, which would make you think that they might be coming in from a seasonality perspective. If you look to the downside, interestingly, this image sensing, even though it's been down 17 out of 20 years, its average is up. They must have had a couple of really big years. But you could see 8 years out of 8 years, Mizuho Financial down average of 5%. Capital Product Partners, 8 out of 10 years, down 10%. Just to give myself an idea of where the winners and losers. When I look at code red, at the Morales and Catchers, I see a number of stocks here to the downside that have kahunas, probably about 16, 17. When I compare that to the code blues with kahunas, I can see there's a lot more stocks with pressure to the upside. So I guess my review here is I guess it's not as painful as it felt, and that maybe there's some reason to be somewhat optimistic. Let's close this puppy down, free up some resources. And now let's go into TradeStation and let's take a look at my elder and person signals on the markets. So just to reiterate, what I do here is I go through the major indexes, cash and futures, and what I'm looking for are really 3 things. I'm looking for the color of the price bars. These are an elder indicator. When they're green, the buying window, he says, is open. You can be buying or holding. You shouldn't be selling. When it's red, you could be selling or holding. You shouldn't be buying. I look at this dot here. which is a person buy and a person sell signal. And we'll see on the SOX some little dots right at the bottom of the price bar, which are evidence of a MACD divergence. So NASDAQ, buy signal, 63 on the high jump, green on the weekly, blue on the monthly. The NASDAQ buying window remains open, at least as the market is over the weekend. The Dow Jones Industrials, not as strong. It isn't a person buy, but it's blue, which is sort of a neutral. You could be buying, you could be selling, or you could be holding. And it's bothersome that the Dow is red on the weekly. So the Dow is not as strong as the NASDAQ. The S&P 100, you could see is blue, but on a buy signal, weekly is green. You can be buying here, but with caution. The SOX is now on a buy signal, which came in on Thursday. They're blue, still worrisome with the weekly and monthly being red, so I'm still nervous. So this, to me, is a counter-trend retracement and not necessarily a reversal. Notice the dots here. Those are showing me that there's a positive divergence or convergence on the MACD, and you could see lower lows on the SOX and less negativity on the MACD histogram. That might suggest that a bottoming process is in place. Cash S&Ps, green on a buy signal, green and blue. So really the Dow and the SOX are the problems. The cash, the E-mini futures are not open yet, look like the cash. The NQs, interestingly, the NASDAQ itself is green, but the NQs, because of BIDU perhaps, and maybe because of LinkedIn, went blue this week, but they're still green and on a buy signal. Russell futures also show evidence of some MACD divergence, which might, again, bottoming action, perhaps less selling pressure, but it's blue and on a buy signal. And like the Dow, the Russell still has some concerns with the red weekly. So certainly, and then here's the cash IWMs, look similar. Not an all clear signal on my markets, all right? And I think you're going to see that the Russell and the Dow have lower lows and lower highs. And you could see it right here on the Russell futures. You can see it on the Dow. So these are now officially, in my book, in a downtrend, at least on this term, while the S&P, higher lows, and the NASDAQ, higher lows. So you've got a bifurcation in the market now, but more on that to come. Let's go into HGSI, into the warehouse view. Let's go to Major Markets Plus. Let's go into T, which is all price and volume heavily weighted on the last couple of days, and show the strength in the market. Well, that's kind of not surprising. Maybe the small caps being up, there's a little bit of a surprise. But with the Dow and the Russell selling off, or maybe being in a downtrend, we'll have to take a look at that in the charts. Mid caps holding up there, as are bonds with interest rates falling. On the bottom, oil, commodities, volatility, and then there's the Dow leading the way to the downside for equities. Let's take a look at some of the major markets. Now, this computer is dedicated to these programs, so the charts are the same markups as they were last week. So last week, what did I say? I said a target would be down here, and then maybe we would reverse. So 1, 2, 3, 4, 5, that was Monday. I was spot on. We pulled down to the 200 and we reversed. Now let's clean this up a little bit and take a look. Actually, let's change this to here. And here was the box we've been in. And are we still in this box? Absolutely. So we're in the middle of the box. In a trading range. All I could say is we're in a trading range. We could break out, we could break down. At this point, we've come off the lower part of the trading range. We're now in the middle of the trading range. with the 50-day moving average in blue as support. On a very quick look on a weekly chart here, just to remind us, we have been in a long uptrend. We have not forcibly broken through and stayed below the 50 weekly since 2011. This is not how markets typically go. We are overdue a correction. That doesn't mean we're going to get a correction. Again, we're living in an unusual QE stimulated fake world where interest rates are low and the government is buying bonds and corporate debt to keep that market happy. And so perhaps in a QE stimulated world, and it is a world because it's not just the US Fed, maybe this is the new norm. But we are sideways in a trading range. And like I said, maybe this is the correction we get and then we break to the upside. Don't know. Let's go back to the daily. Let's continue our review of the indexes. Next one let's look at is the Dow, which we know is the weaker of them. And the Dow actually came below where my target is and is struggling now to get back above the 200. Now, let me clean this one up and show you what my concerns are with the Dow. Lower lows, lower highs. And this low, by the way, is also a lower low. So it'll be interesting to see, to me, what happens here. So where the S&P is sort of flat, the Dow has broadened the range, has broken below that 50-week moving average, although it's trying to reverse, and is starting to look to me like it might be entering a downtrend. It's going to have to get above this point here for me to change my mind on that. NASDAQ looks like the S&P in a trading range trending up right in the middle. Look on the weekly on the NASDAQ, and you could see it actually broke out. What was that line from? Oh, that was the all-time high. I'm sorry. Broke out to all-time highs, has pulled back down, is really right at that point now. But on the weekly, on the daily, clearly the NASDAQ is in the upper half of a rising trend. Strength compared to the others. And then the Russell, kind of like the Dow, Russell pulled down to the 200, at least it held above it. Now has to get above the 50. And if I clean this puppy up a little bit, I have the same issue here as I had with the Dow. Lower highs, lower lows. So have we changed, or is this just a short-term pullback in a long-term bullish market, which is probably the most likely? And you could see here on the weekly, we've pulled back to support that we've stayed above for most of this run-up since 2011. All right, so we've looked at the major indexes. Let's take a look at the dollar. So again, with the same theme of moving averages, do you notice anything about the dollar moving averages? Sure. The dollar pulled back to the 50 and held on multiple times, and that's turning out to be pretty good support of the dollar. Dollar's in an uptrend. Off of support, dollar's going to go higher. If I look at volatility, volatility keeps failing at the 200. We're not down to the lowest of the lows, but we're pretty low on the VIX. If the dollar is pulled back a little bit, maybe gold bumped. And gold bumped a little bit on the week, but really not much, kind of flat. And silver is also, I think, in the penalty box with gold, underneath all of its moving averages, which have been resistance multiple times in the past. All right. How about sectors? I added something here. I just put the sector ETFs in. The strongest sector was utilities and consumer discretionary and healthcare. We saw that on Thursday when we looked through the various industries and TradeStation. Let's just take a look at these one at a time and make some comments about what I think is going on, sector strength or not. Utilities have been in a downtrend since February. If interest rates are going up, that's not good for utilities because it becomes more expensive for them to borrow money and their dividends become less impressive when you can make more money in a bank. With the Fed looking to be on hold, you could see they rallied through the week, although a bit of a shooting star on Friday suggests utilities are ahead of themselves. If you think about this candlestick, that means it opened, traded up, and then came right back down to where it opened, topping tails. And if you look historically, usually when you see things like this, you're getting to a market, at least a short-term top in the market. You usually don't have a topping tail and go up the next day. Consumer discretionary, one of the leaders, if not the leader, lower left, upper right, broke out here in July. A little bit of indecision day on Friday, can go either way. Healthcare has been strong, and no reason to say it's not going to be strong. It's certainly not extended off of the moving averages. Consumer staples, again at their high or at the high end of a trading range. Industrials have been weak and continue to be in a downtrend, although they've come up off their bottom with this sort of this island reversal here. Materials bounced early in the week with some of the steel stocks, ore stocks, gold stocks, and oil stocks leading, and they gave back a lot on Friday, but clearly not leaders in the market. Finance in an uptrend in the middle of the range. Rising rates will be good for this sector. Technology, middle of the range, sideways at best. And energy sort of leading to the downside. Big time. All right, let's take a look at the sectors, or the industry groups. So we've got 173. I think last week we had 3 or 4 on Sunday that were positive. We had a little bit more on Thursday, and we've got a lot more today. We've got 66 industry groups to the upside. So with the market kind of puddling along and moving up over the last couple of days, and with this number of industry groups positive, why am I not feeling better? I think because we're still in a trading range. To the downside, I've got only 13. Notice how many of these are energy, exploration, renewable energy, integrated oils, and midstream are all to the downside. Rail freight, which has a substantial component of its finances are related to transportation of energy, also to the downside. And you notice the semiconductors, both devices and manufacturers and consumer electronics and computer hardware and storage are to the downside as well. So technology and energy being weak. Let's go look and see what's at the upside. Start with communication equipment. I looked at a lot of these. Which ones stood? Well, several of these stood out. Let's start with Juniper Networks. Let's go into my usual. So Juniper had a buyable gap up, traded down to the 50. Looks like it wants to run again. It's not a bad buy position because you got a pretty good place to put your stop at the 50. 8 crossing above the 50, 17 will cross the 50 this week. You had a couple kahunas. Everything is green. You make money. have a small dividend. Juniper Networks, which is an old name, looks as good as anything else I'm going to show you, sort of a cup and a handle and a breakout on the weekly. So Juniper Networks is on my buy list as a watch. Nokia, no thanks. Ruckus Wireless, sort of sideways, breaking out above the 200. It might be a good story. I don't like the chart, too loose. NetScout, no thanks. A10 Networks, this had been a big mover, pulled back pretty hard, now breaking above the 50. It's a cheap stock, not interested. Sonos, no. Cisco, you know, I'm not a big fan. I think the growth days for this company are over. Look at their tepid EPS growth, but it isn't an uptrend long term, I suspect. It's and a pullback to the 50-day moving average, and it, you know, a kahuna off of here might mean it runs back up to the 30-31 range, which is a 10% move. The others that I liked here, Inferna, nice lower left, upper right, good earnings per share growth. Starting to get a little bit, well, it's not really extended yet. And Sienna looked pretty good as well. Pull back to the 50. I'd like to see a kahuna or something to come in. Let me just see if one other thing that I liked is in here or not. So this is communication equipment, and they got a couple things that look decent there. Biotech. Really, Amgen had great earnings. You know, Amgen's an enigma to me. Look at a monthly chart. This is a company that did nothing for a decade. And this was a decade where their old CEO, Kevin Scherzer was there. And they changed the CEOs. They became a growth stock again. They've tripled since 11. The enigma is that they have an aging number of biologic drugs that will have biosimilar competition starting in September. And they've got some new cholesterol and other drugs that are exciting. So interesting company, broke out this week, kind of a shooting star on Friday. I probably wouldn't touch it at this point. Medivation, they have a single product for prostate cancer that is also marketed by Astellas. It has good numbers. Don't understand the slowing earnings per share growth. That's bothersome. PE is high, especially if you're not gaining, you're not growing. So don't like the chart pattern, although I do like the company. I do like Gilead. It seems to have pulled back and found support at its 50 and wants to go again. Good earnings per share growth short term. The concerns on this company is they have a blockbuster Hep C franchise, and at some point that's not going to grow anymore, and they'll have competition. And how do you replace that amazing growth that's taken them from 48 cents in a quarter in June of 2013 to $3 in a quarter now? And that's the big concern. And you looked at Amgen's multiple, that's in the high 20s. Theirs is only 11.6. So they're being discounted. They're buying back shares. They've created a dividend. And I think the street's looking to see them make an acquisition. Vertex, have a number of CF drugs, sideways, trying to break out here. Don't love their earnings, although I think it's more a story on a new launch coming. Below the 50, we'll skip that. Puma would be a bottom fish on an expensive stock. Probably I don't play that. Which ones do I like in this group? Intrexon has been a leader. It's starting to get extended. Look for a pullback to the 50-ish area as a place to get in. They have some interesting cancer products. Bluebird Bio, again, another very expensive stock at a decent buy point. Why is it a buy point? Because I've got a well-defined stop about where that line is. I had a kahuna come in. I had a PSA reversal and a mobile breakout from a squeeze, but it's a $165 stock. Again, interesting cancer and gene therapy products. Regeneron, the big kahuna, $555 stock, beautiful uptrend. Whenever you can get this stock near the 50, you just buy it. Pinch your nose and buy it. Buy 10 shares, whatever you can afford, because this is a stock that loves to pull back to the 50 and then run up. Kite looked good. It's a relatively new issue stock. sort of been basing, pulled back to the 17 and 8, had a mobile breakout and a pocket pivot on Friday. So several stocks look interesting. We may come back to that later. Specialty pharma, PCRX, take a look at a couple of these. It's a pretty deep pullback. 2 kahunas, 2 pocket pivots, a mobile breakout from a squeeze is enough for me to take notice. It's got big earnings coming into the stock. Has a big multiple. I'm going to pay attention to this one this week, even though it's in a downtrend. It looks to me like it's reversing after a series of bingos. Synergy Pharmaceuticals ran up, has gone sideways, had a mobile breakout squeeze and a kahuna on Friday. I've been hearing good things about them. Don't know them. Endo, run up, sideways. Give me some momentum. Give me some kahunas. I might get interested on that. Radius Health, I actually have a position in this one. Had a pullback this week, sitting right on the 17, looking for some momentum to take it to new highs. Valiant, one of my, probably the most expensive stock I own. Beautiful long-term uptrend. You could substitute Allergan, the old Activist, or Watson, same type of a story. Serial acquisitions, they've moved offshore for better taxation rates. What a beautiful stock to own, and it's not a trading stock. I just own it and forget about it. Growth rates twice the multiple. It'd be nice to see them buy stock and pay a dividend, not their model. Fold is one I've been into for a while. It's a preclinical company that just a nice lower left, upper right, and tight. Buy it on pullbacks. I think that's the message for everything. Buy it on pullbacks. One of the ones that I also have a big position that most people realize. Well, I've got a good position in DepoMed here, which popped up when my other one, Horizon, put an offer to buy. They had decent earnings. I have to decide what I want to do with that. Horizon has been a great growth story this year. They've got earnings coming out Friday, so it's probably not something to buy. Historically, it just pulls back to the 17 and runs. It's sitting on the 17 now. It does have earnings. These are in air. I would probably wait for the earnings on Friday before I go back in and buy more of this stock. Fourth one down, apparel and footwear. Skeechers, just every time it has earnings, it blows out the number. It has a float that's relatively small at 40 million. Anything less than 60 is small in my book. Anything less than 100 is smaller. And small floats have big moves on surprises. Maybe hard to buy the stock now, but gosh, every time it does this, this isn't the, I can go back here. It has a tendency of having gap ups, then was sideways for a long time, gapped up, sideways until earnings, and gapped up again. This is a great growth story, and with back to school, this is the first time I've seen a negative earnings growth print. That's a little bothersome there. Columbia Sportswear must have had earnings. Michael Kors, bottom fishing. Deckers, bottom fishing. Crocs, hard for me to buy Crocs, pullback. Not horrible, uptrend, pullback to the 50. Everything's green here. A mobile breakout from a squeeze on Thursday. Pocket pivots and kahunas. What else we got here? Back. REITs. Interest rates are falling. These are good for REITs. 3% yield on Taubman's shopping centers. Reality income. I did like one of these more than others. This isn't a bad looking pattern. Only pays a 2.4% dividend. If this was a stock, you got to pull back to support with a kahuna, pocket pivot, mobile breakout from a squeeze, and a buyable gap up all in the same 2 days. So that looks interesting. I like this one a lot. Similar pattern. Kahuna, pocket pivot, breaking above the 200, mobile breakout from a squeeze, all is green. It pays a 3.2% dividend. I'm not an expert in REITs, so I'm not going to spend any more time there. Beverages, is that defensive or what? Maybe that tells you something about this market and the concerns. Cease Coca-Cola Enterprise. I wonder if, let's go to info from web. Is this earnings or is Coke buying them? Merger talks. Okay. I had heard that Coke might be buying some of their major bottlers. So don't play that one. Coke must be the other half of the trade. You know, it's below the 200. It pays a 3% dividend. It's been sideways since March in the choppy market. I don't like buying stocks below the 200. Keurig, next. Brown-Forman. Now, this is a nice looking stock. Beverages, don't know really much what they make. Nice up move, but it's at the top of the high jump bar, probably too extended. Back. Restaurants, another defensive play. Steak Shack actually looked pretty good. I got to admit it, that I've eaten there a couple times. I still don't get it. It's not back to its post-IPO high, but from a chart pattern, it's breaking above the 50 with a kahuna, mostly green up above, looks interesting. A lot of demand, makes a few pennies, trades at an astronomical multiple. That's the concern I would have there. McDonald's, how boring, but sideways, trying to break out, did have a shooting star after a pocket pivot, skip that. Buffalo Wild Wings must have had earnings come in here, or maybe those were on CMG earnings, a nice breakout. These are expensive stocks, multiple of 40, no dividend. Fiesta Restaurant Group, Bible gap up, sold off most of the day after the gap up on a kahuna, got above the 200. Not my kind of stocks, although maybe it's the right thing to be buying now. Medical equipment, I do like the second one a lot. Hologics I didn't look at, but maybe I should have. Two kahunas, a pocket pivot, pull back to the 50, and then a bounce here. Bible gap up on Thursday, stayed the same on Friday. Nice looking chart, probably worth a little bit of research. It's less than 10% above the breakout point. I might take a look at that. Catalent, another medical device. I did have a Bible gap up, I think, over here. It did. Same group. Earnings are up and down. PE is a lot smaller. Zeltic Anesthetic was sideways, had great earnings with a Bible gap up on Friday. Still losing money. I guess they lost less than expected. Dent Supply, sideways, breakout, multiple kahunas. These stocks all look pretty good. This might be a arena and medical equipment devices that you might want to be looking at. Integrated utilities. We talked about utilities being strong, especially with interest rates falling. The charts are not beautiful charts. Remember, the sector looked horrible. So far, all these are below the 200. Here's one breaking above the 200. The story here is defensive. And if the economy suffers, they have great dividends here, 3.7%. The last group in the top 10 are telecom carriers. T-Mobile must have had some big news come in on Friday. Let's see what that was. They had a nice move up. Nice looking chart. Uptrend, pull back to the 50. Mobile breakout from a squeeze. Pocket pivots, kahunas. I know there's some M&A discussions on with these guys, among other things. Sounds like they're improving as a company. So I would say that from a stock-wise, T-Mobile looks pretty interesting. Ring Central, don't know this one. Big move up on Friday. This is a South American. Vonage, the internet phone. Verizon pays a nice dividend of nearly 5%, but it's in the penalty box. CenturyLink, another one in the penalty box, pays 7.6%. All right, so we've now looked at some of the stocks that are moving to the upside and the downside. Let me show you my chart of the day. So my process is I accumulate a lot of watch lists over the week. Some of these are smart groups on Friday. Some of these are from MarketSmith. Some are filters from HGSI. Some of these are IBD lists. Here's the MarketSmith 250. Some of these MS are MarketSmith, and some of them are from Metastock. Here's my screens of the day from IBD. And then I have a bunch of TradeStation scans. including person high close dojis, daily and weekly, and person long and shorts. I throw these into two watch lists. The first watch list is called Consolidated Buys, which was 1,346 stocks. I then add the S&P 1500 into it, and I get a list of 2,000 stocks. In my trade station, I then run John's indicators against that list of 2,000 stocks, and I look for stocks that have buy signals and have or high close dojis. So that would be this list here, and we're going to talk about AMSG, which had a high close doji, a person 1, which means a buy signal while it's in an uptrend, and there's the buy signal on the weekly and the daily, clearly in an uptrend, and there's the high close doji, and a buy signal 2, which says, oh, it did not have a buy signal 2. It wasn't at monthly pivot support. So let's take a look at AMSG, and here's how I would evaluate it and take it all the way to a trade. So let me just set my stuff up here. Okay. Here's a chart of the week and why. Look at all the charts we looked at. Here's a lower left to upper right. That's a leader. Clearly, and this is today's date, this is pulled back to the 50-day moving average. It would have been a great buy on Friday because it had a mobile breakout from a squeeze, turning green on my technicals up here, had a pocket pivot and a kahuna, and OBV is turning up and it's above the moving average. Speaking of moving averages, because it's in a squeeze, I've got my 8-day, the 17th, and the 50-day coming together. My 200's in an uptrend. We are not at the high jump. Looking up here, I see nice revenue growth quarter over quarter, as well as earnings growth. I see that we're accelerating my earnings growth with a 29 and a 29% growth. My multiple of 27 is comparable to my growth rate. I'm willing to pay up to twice the growth rate as a multiple. My average daily volume is not great. That's a potential negative, but it's above my 250,000 or 150,000 limit. Earnings are due August 4th, so that's a problem, so I might want to wait till earnings come out. Earnings are Wednesday. Dividend yield, it does not pay one. Okay. So I love the chart. Again, I might wait to earnings, but we're going to take a look at potential trades. So if I go into my person signals on TradeStation, this is a high close doji with a buy signal. A high close doji is defined as a close above the high of the doji bar. A low close doji would be an uptrend, and you have at the low. Now, there's not much of a downtrend here, although there is a little bit of a downtrend, so I'll give it a high close doji. I'm on a weekly buy signal, which is this little rectangle as well, clearly on a monthly and an uptrend. OBV is pointing up on all time frames. On my indicators, you could see that on Friday I had a mobile breakout and a pocket pivot from a squeeze, a PSAR reversal, and a positive force kahuna. So there's a lot to like in this stock. This white line here is my last conditional change, which is often what I use as a stop. It's 68.69 on the daily. It's 67.69 on the weekly. So I took a look at this, and I'm going to pretend the earnings are not out in 2 days, and I'm going to look at buying the stock. Trade consideration. Closing price Friday, 71.74, just off the high of 71.80. I would put a buy order in at that high of the day. The rules on a high close doji is you take the trade at the open. By putting it at the high of the day, as soon as the stock trades up, I'm going to be in it. If the market opens down because China sells off tonight, then I probably won't get filled, and I don't want to get filled. If this is a false break and the stock trades down off the open tomorrow, I won't get filled. Now, I have a lot of places to put my stop. The last conditional change is at 67.99 on the weekly, 68.69 on the daily, and the lowest recent close, which is where my arrowhead is at 67.69. So I'm going to assume I get a buy price at 71.80. My stop will come in. I'm going to take the lowest of these three right below it at 67.65. I'm risking $4.15, which is 5.8% on the trade. I'm very comfortable with that. If I'm willing to lose $2,000, or that's my risk capital on a trade, then I can buy 2,000 divided by 415, or about 480 shares for every $2,000 of risk I'm allowed to take. So this is the perfect stock I want to buy, except I don't love when the earnings date is. That's a concern. How can I trade this? I can buy stock outright. I can buy a call. I can buy a call spread or a put spread. I can buy covered stock. I can buy a synthetic, or I can do my favorite chicken shit synthetic. So let's just look at what those might look like. So I'm not going to probably buy an August option. I'm looking out a little further, so I'm going to probably look at September off. I've got at least 47 days. So I can buy 480 shares and risking 2,000. Okay. John Person would say to me, Jeff, look for a Delta 30 call. A Delta 30 call is going to be a September 75 call, which I'm going to pay somewhere probably about 80 cents for, somewhere in between the bid and the ask. So if I thought for sure that AMSG was going to have a big move, then I could buy an out-of-the-money call, a Delta 30 out-of-the-money call, and again, it's going to cost me probably in the 80 cents to $1. I could buy 20 calls for $2,000. Each call is 100 stocks, so that would be 2,000 stocks, 2,000 shares controlled for a total investment of $2,000, and I would make money when the stock trades above 76. My probability of not making money on that trade is about 75%. I could buy a 70 call, and probably end up paying $3 or $4 for it. And it would have to go to $74 for me to break even, and I've got a 65% chance of that happening. I see a problem right now with this spreads being so wide. My guess is there's not a lot of volume and open interest at these. Yeah, there's basically no volume in these calls. So buying a call on this stock is going to be dangerous. It's going to be dangerous because it's going to be a big spread getting in, and I'm going to buy it close to the ask. And it's going to be a big spread going out. I'm going to sell it close to the bid. So I'm not a big fan of that. Now I'm just going to keep playing the story. Let's say I don't like those options. I could look at verticals, and I can buy a, say, 71.80. So 70, pick this, and let's change this to, all right, so I can pay $2.05, and I'm buying a 70 call and selling a 75 call. The most I can make on this trade is $5, but I'm only paying $2. My break even is going to be 72.05, which is only 31 cents away. So one way to play this would be to take a small gain at a high probability trade, make 3, risk 2, which is in my favor, and for me to lose on this trade, my entire $2,000, and I could buy 10 contracts here. For me to lose my $2,000, it would have to trade below $70 before I have nothing left to show for it, because there's $1.74 of value in that call besides the premium. Now let's say I want more room. Let's say I'm going to sell an 80 call. Here it looks like for $2.55, I can control 100 shares. So there'll be $2 times 10 for 1,000 share for one call, which controls 10, will cost me $2.55 per share. If I want to buy 10 calls, which will control 1,000 shares, so one call controls 100. I'm sorry, I'm doing gibberish. It'll cost me $2,550 to control 1,000 shares here. And I have an upside of $10, and I'm risking $2.55, and I break even is $72.50. I probably like that trade a little bit more if I can get it filled at $2.55, which is a question mark. All right, now something else I could do is say this is going up, so I'm going to sell a 70.65 put. So I'm going to sell a 70 put, and I'm going to buy back a 65 put. So this is on 1,000 shares. It's going to cost me $1,000. So it's $1 per share. And as long as the stock closes above $70, and I'm bullish on this position, as long as it closes above $70, I make $1. I have a maximum risk of $5. Now, I'm not a big fan of this trade, although I do these trades on some of the higher cost stocks because I can be way out of the money and make some money on it. That's a bull put spread where I'm selling the close input and buying a further output for protection, putting the premium in my pocket, but realizing my gain is limited to $1. If this stock goes to 90, I made $1. If it goes to 80, I made $1. If it goes to 60, I lose $5. Not my favorite kind of trade. A synthetic trade, on the other hand, would mean I'm going to look at the $70 So what I'm looking at here is I'm going to buy a $70 call and I'm going to sell a $70 put. It's going to cost me $1. What that dollar tells me is if the stock goes up, I make money because I'm already in the money. My break even on this trade is $70.95. I've already got 84 cents profit on this trade. So if the stock goes up, I make money. If the stock goes below $70.84 or 89 cents or whatever it comes out to be, I lose money because I've sold a put, which means I'm responsible if it drops. Now, this has the exact same win and loss opportunity as owning the stock. So let's look at some of these curves. I just like doing this in option view because I think it's very clean. So I'm going to run this in option view. I'm going to probably want to update it knowing option view. Let's see. Yep. All right, hold on. This will take just a second. High-speed internet is a wonderful thing, isn't it? All right. So, we're talking about AMSG. Let's open it up. Okay. Give me a couple seconds here to set this up. Okay, so I'm going to make some curves for you. Let's say that we bought, we're going to buy 1,000 shares. That's what my P&L curve looks like. If the price of the stock goes up, I make money. If the price of the stock goes down, I lose money. Okay? Remember that. I don't think I can open up a second one. Let's see. How about if I just buy the call? So we talked about buying the 70 call in September. So we're going to buy 10 calls. If I just buy calls, I lose money until the stock moves enough in my favor to cover my premium, and then I make money on the stock, on the option, just like I own the stock. That's not too bad. The problem with this trade is it's going to cost me some money because I got to put out $2.80 per call. It has to move up to $72.10 for it to break even, so it needs a positive move. And I'm risking that much on the trade. Okay. Remember the $2,800 to get in. How about if I buy $70 calls and I sell $80 calls? Whoops. So now my break even, it's $22.50 for me to get in the trade. And my break even is a little bit less, although it doesn't look that way. But my gain is capped. So I'm giving up some of my big gains, but I'm getting in at a cheaper cost. So I'm giving up an outsized gain for a lower cost of entry. I like that trade. How about if I decided to do that bull put spread? So I don't think the stock is going down, so I'm going to sell 10 puts at 70, and I'm going to buy them back at 65. And I'm going to analyze this trade. And now you could see I've limited my gains to the value of that premium, but I don't lose money until the stock moves significantly against me. So this is a trade that says the stock's going up, I'm going to put a small amount of my money in my pocket, and I'm just going to hope the stock doesn't go down too much. Now it requires a lot of margin because I have to be able to pay off the loss, but the cost of going in the trade is very small because I actually get paid $1 on the trade. And then I'm just going to finish with what I call my chicken, or not my chicken ship, but my synthetic, which means I'm going to sell $70 puts and I'm going to buy $70 calls. I'm going to hit analyze. What does that look like? That's the exact same return as the stock. For me to buy 1,000 shares of a $70 stock, I've got to put out $70,000. My cost of this trade is about $2,000. I have to have margin, of course, of $22,000 because the risk of losing money. But I'm able to reduce my cost of entry, control 1,000 shares for the same $2,000 cost, but I run the risk of losing money or gaining money. And just to remind you, if I had just bought the stock and I bought 1,000 shares, it's the exact same risk, profit, and loss graph. And lastly, what I've become increasingly fond of is a little bit safer play where I'm going to buy the call, whoops, and I'm going to sell the put at the same price, but I'm going to buy myself a cheaper put to protect myself. I'm going to hit analyze, and this is a trade I like to take, and it's probably the trade I'm going to put on here, where I'm going to buy a $70 call and sell a $70 put to pay for it, and then I'm going to buy a $65 put to protect the put that I sold, limiting my downside risk on 1,000 shares with unlimited upside. That's just one way of trading, and I call that my chicken shit synthetic, because it's a synthetic that I buy a put on it to protect myself. So those are just a couple of ways that I look at actually taking a trade based upon what I found in my charts. So just the last couple of minutes, I want to run through just a couple of charts, and these will be some of my buys. Now, I'm not going to go through all my buys. In fact, I'm just going to leave it open for a second so you could see who my buys were in case you care. These are some of the stocks that I liked. You rank them by combo. And then let me just show you my filtered buys, the ones that I'll be paying most attention to and why. Several of these we've seen already, and then we'll say goodbye. This is Molina Healthcare. This is a managed care provider. They do a lot of Medicare, Medicaid, a lot like Centene, probably a potential acquisition candidate. Had some great earnings come out last week. Next earnings aren't until October. Lower left, upper right, Bible gap up, mobile breakout from a squeeze, Kahuna and Pocket Pivot on Friday. Shake Shack, we already talked about. Synergy Pharmaceuticals, I like it. Mobile breakout and Kahuna on Friday. Let's see if it can take out that high and move to higher highs. Wisdom Tree Investments, sideways move, breakout on Friday, mobile breakout, squeeze, Pocket Pivot, Kahuna, great earnings per share growth, pays a small dividend. Bluebird Bio, I already talked about it, expensive biotech play, coming off a base with a mobile breakout and a Kahuna. DCT, that's that REIT I liked, which a breakout above the 200, a Kahuna and a mobile breakout, and a Pocket Pivot and a squeeze. If I had to buy a clothing store, I'd buy American Eagle Outfitters, but I already own this one. Uptrend, pull back to the 50 with a Kahuna on Friday. AM Surge, that's my chart of the week. Kite Pharma, we already looked at. AMC Entertainment Holdings. If I go back to a weekly stock, you could see that this stock has been an uptrend. Pretty big pullback from 36 to 28 on the weekly. I don't really care about the yearly. And looks like to me like it's setting up to run again. AAOI, another stock. This was almost my stock of the week, chart of the week. Clear uptrend, pull back to the 50, mobile breakout. I'm looking for this one. It's kind of a flag after the Bible gap up. It looks like it wants to run again. It's got great earnings coming in. And then another communication equipment stock with good EPS growth is XXIA. Sideways, had a Kahuna off the 50 on Friday. These are all stocks that also passed my person filter. So I just want to close with saying thank you for being here. We'll see you next year in Florida, or even October, November at John's or in Anaheim. And please consider the PV meeting. If you go, you won't be sorry. Good night, everybody. Have a great trading week, and thank you.